What's going on, guys? Welcome back to a new video on the channel. Today we're going to be analyzing American Express, ticker symbol XAP. Now, this stock is really special because even Warren Buffett owns it, and there's a ton of videos about it, right? It's also a blue chip, and it's very well valued, so let's take a look at it. So first things first, this thing has a market cap of 120 billion, so way bigger than my usual stocks that I analyze, right? It pays a dividend and the price to earnings is about 16%, but we'll get to that later. So you can see that in the chart that the only hits it has taken is during COVID, and then right now it's about 18% from its all-time high. Right there. So now let's take a look at the growth of American Express. So you can see that the growth is actually really good, except the COVID and 2017 for some reason. However, the revenue growth is really good and is estimated to be really good in the future, as well as the profit margin, which is usually above 14%, which is great. And then also the earnings, of course, are great. Oops, I just bumped into my mic. That's fine. But anyway, now let's move on to the free cash flow margin chart. Now this one is also pretty good because first of all of the margins are at about 25%, which is great, and the only years that aren't above that are 2017, 2017 is really good for free cash flow, but 2016, 2018, and 2020 again, of course, 2020 being the biggest hit, and yeah, but pretty decent free cash flow growth, especially in the last year, last 2 years, so really good there. Now, for the valuation, you can see that the PE is a pretty average right now, or in the last year, and it's actually at a 10-year average right now. However, there are some years where the P is really high. Of course, 2017 and 2020 again, and it actually is lower than the 5-year P. But anyway, so the enterprise value to earnings and enterprise value to free cash flow is pretty much the same because they don't really have any debt. So I'll just skip that. And then book value chart. Don't mind the percentage of current assets. Stock Analysis just doesn't have it correctly, and that's where I get the data from. So I don't know. It's just for this one stock. It doesn't work for some reason, but it's fine. Anyway, you can see that the book value is not too bad compared to the market cap, and it's also growing. Not by a lot, but it's not terrible. So it's fine with me. And then this is just a comparison of earnings to revenue. But anyway, now let's move on to the health. And here you can see that American Express basically has no debt because they can basically pay it off with their cash. And also they can pay it off with 2 years of their this year's free cash flow, right? So now let's move on to the assets and liability. Actually, we skipped shares outstanding, which is just great. They're buying back the shares really aggressively, so that's great. And then assets and liabilities are also both on the climb, but the difference or the spread between them is still growing, so that's fine. And then I'll just skip this. We don't need that. It's just the division of assets right here, but nobody really cares about that right now. So let's just go to the ratios, and right here, the ROE is actually pretty. The return on equity (ROE) is actually pretty high, but ROA is okay. But ROIC is actually really low, especially compared to the market average, which is like 8 or 10. I don't really remember. It's something like that. I think it's 10 actually. So it's the average of American Express is like 4 or 5, so not too great. But again, this company does have a huge moat, so it's not too much of a problem because, first of all, American Express is it's not a duopoly, but it's one where it's, do you call it a truopoly? I guess. So it's a truopoly with Visa and MasterCard, and basically nobody can get into the market that easily. Like nobody can just create a new card and most of the businesses accept only these three companies: Visa, MasterCard, and American Express. So it's not too bad. But then they do pay a dividend. It's not too high, but 1.3% dividend yield for for a 20% payout ratio is not that bad. And then the change in investments. So here you can see that in 2020, it was the only year, or well, basically the only year that they had to sell some of their investments in order to get cash back. But most of the time they just what do you call it? They just I forgot. They just invested into some of their assets, right? But same with the acquisitions. Basically, they never really sold anything. They kind of just bought some of the businesses. But now let's value American Express. So for the growth, I'm gonna go with 4, 6, and 8% because I want to be pretty conservative, and the highest. Actually, their 5-year average is about 8%, so that's what I'm gonna do for their high, because the 5-year average also includes this 1 year huge 15% growth rate, right? So I'm just gonna do 4, 6, and 8, a little bit more conservative, and then for the profit margin, I'm gonna go with 12, 15, and 17, 18. Sorry. Actually, I feel like 18 is a little bit high, so I'm just gonna go with 12, 14.5, and 17. Right, and then free cash flow margin, I'm gonna go a little bit lower, actually a lot lower, with this one because I feel like they should come together a bit. So I'm just gonna go 15, 18, and 21. Now for the PE, this is just a standard PE. I'll just go 12, 14, 16. That's what I usually do. And then for the free cash flow, since it's a little bit lower at the 5-year average and 10-year average, and especially only the 1-year average, right? So I'm just going to go 10, 12, 14. And as you can see, I'm just going to leave the discount rate as it is. And then as you can see, it's not too bright right now, but the stock is basically at its all-time high, or like very close to it. So it's not a great buy right now, but if you bought it, if you did buy it, you would still get like 9% in the mid scenario, so not too bad. But overall, I think that the buy price, or the price that you should be buying the stock at, is somewhere from 130 to 140. I feel like that's a good range to buy the stock. It's probably not going to get there in the near future, especially because it's at the bottom of the trend line. Actually, if we do a little bit of technical analysis, there is this trend line right here, which if we just place it like this, I don't have it selected, it is right at the bottom of it. So I didn't draw this perfectly right. It can go many ways. It could even go like this, but it's pretty much at the bottom of it, and you can see that it already bounced. So it might, like go up like 20% and then, bounce around in this in these two trend lines for a while. So maybe gonna see it break out to the downside sometime here, maybe in 2024. But overall, I think this is a great business, and yeah, I'm just gonna add it to my watch list at 135. So yeah, that's what I'm gonna add it at, and yeah. Anyways, guys, so I hope you enjoyed this video. If you did find it useful, I would appreciate you subscribing and liking this video. You can go check out the website. Actually, I'm on my local testing server right now, but this is just the same thing. So you can just go test out the website at this link. I don't know why I was on the local testing server, but anyway, so you can just go check the website out at this link. I'll make sure to leave it down in the description, and all you gotta do is just click the sign up button, and then enter your email in right here and your password, and then you can just sign up. And yeah, so you can just follow along with everything I do. But anyways, I hope you enjoyed this video, and I'm just gonna see you in the next one.